Welcome back to the Deep Dive. Have you ever wondered how some of the biggest tech giants, or even those promising startups, manage to attract and keep the best talent, without just constantly upping their salaries?
Right. Or maybe you've seen a company, it looks really profitable, but then they report a surprising loss.
Exactly, and you scratch your head thinking, what is going on there? Well,
Yeah.
the answer often lies in this really powerful, sometimes kind of complex, but definitely fascinating area: stock compensation.
Mm-hmm.
Today, we're going to pull back the curtain on this often misunderstood financial tool.
Indeed. And stock compensation, it's really far more than just, a line item on a balance sheet.
Oh,
It's
yeah.
actually a core component of modern business strategy. It influences everything: recruitment, employee retention, a company's overall financial health, even its appeal to investors.
Wow.
It lets companies align employee interests directly with shareholder value. It kind of fosters this sense of ownership from within.
Okay, so our mission today is to take, well, a whole stack of information on this topic, from the real basics up to the tricky accounting stuff, and pull out the most important nuggets for you.
Right.
We want you to walk away not just, well-informed, but hopefully with some of those real aha moments where you can connect the dots between, say, executive decisions, employee incentives, and what you actually see on the company's financial statements.
That's the goal.
Okay, so let's begin our deep dive. What exactly are we talking about when we say stock compensation? Let's start right there.
Well, at its heart, stock compensation is basically a way for companies to give employees a direct stake in the company's future success.
Okay.
It's tied directly to the value of its shares. So it's about more than just the paycheck. It's about sharing and the potential upside.
And the form that I think most people probably think of first, the one you hear about with all those startup success stories, is the employee stock option.
Right, the classic stock option.
So maybe think of it this way. A stock option isn't actually a share of stock itself, right?
Correct, it's not the share yet.
Instead, it's a specific kind of legally binding right to purchase shares of the corporation's stock. But here's the crucial part. You get this right under very fixed conditions, like specific timing, place, and, importantly, the price you'll pay, all predetermined.
That's exactly right. And the appeal for the employee is, well, pretty clear. Companies often grant these options with an exercise price. That's the price you pay to actually buy the shares later that's set when the option is granted.
Okay.
And sometimes, though not always, it might be lower than the market price at grant, or the hope is it will be much lower than the market price later when you exercise.
Ah, so there's built-in potential profit.
Exactly. Potential profit. The moment they exercise their option, if the market price is higher than their exercise price, they could theoretically sell it right away for a gain. It's like a deferred discount on future wealth directly tied to the company growing.
That does sound like a fantastic deal for the employee, especially if the company's stock really takes off.
Yeah.
But from the company side, are there strings attached? Like, how do they make sure this aligns with their long-term goals and people don't just cash out immediately?
Absolutely. Good question. To really make sure it aligns with long-term goals and, prevents quick speculation, most option agreements have something called a vesting period.
Vesting. Okay, I've heard that too.
Yeah. It's a specific length of time, could be 2, 3, 4 years, sometimes even longer. And during that time, the employee has to perform services for the company to actually earn the right to exercise those options.
Ah, so you don't get them all at once.
No, typically not. If an employee leaves before their options vest, they usually forfeit them, lose them.
Okay.
This rule is really designed to kill pure short-term speculation. It makes sure employees are genuinely invested in the company's sustained growth, not just a quick market blip. It ties their potential reward to the company's long-term success.
So it's not just a gift. It's something you earn by sticking around and contributing. That makes a lot of sense for retention. But, okay, from the company side, how do they account for this stuff, these potential future payouts? It can't just be free money on their books, right?
No, definitely not free. From an accounting perspective, the cost of this compensation is measured by its fair value.
Fair value. Okay. How do they figure that out?
Well, it's not just a number they pull out of thin air. It's determined using pretty sophisticated financial tools, often called an option pricing model. Maybe you've heard of the Black-Scholes model.
Vaguely. Sounds complex.
It is. The math behind it is complex. But you don't really need to understand the mechanics of Black-Scholes itself. The key thing to grasp is its purpose.
Okay.
Its purpose is to provide a concrete, objective value for these options on the day they are granted. It looks at things like the stock price, how volatile the stock is expected to be, the option's exercise price, how long until it expires, even interest rates. And that fair value amount is what the company will eventually recognize as an expense for getting the employee's service.
Got it. So there is a calculated cost, even if cash isn't changing hands right away.
Exactly. And this brings us to a really fundamental distinction. These stock options or purchase plans, they generally fall into two broad categories based on their main purpose and how they're structured.
Okay, two types.
Yeah. They can be either non-compensatory or compensatory. And knowing the difference is critical because it has huge implications for how they get treated on the company's financial statements. It directly impacts reported profit, the balance sheet, everything.
All right, here's where it gets really interesting, I bet. Because you're saying not all stock plans are treated the same way by the accountants.
Not at all.
This big difference between non-compensatory and compensatory plans, it sounds like it really changes how a company reports its financial health and what investors, need to be looking out for.
Precisely. Let's start by diving into the first type. Non-compensatory stock option purchase plans.
Okay. Non-compensatory.
The intention behind these plans is quite specific, and that's the key difference. They are primarily used by companies either to raise capital or to diversify ownership among a broad base of employees or officers.
Raise capital or diversify ownership.
Yeah.
Okay, so not primarily about paying people for their work.
That's the idea. It's more about achieving these broader corporate finance goals. Think of it almost like a mini public offering, but just for the employees.
Interesting.
Now, for a plan to actually be classified as non-compensatory under U.S. GAAP, those are the accounting rules here in the U.S., it has to meet all of four very specific requirements, every single one.
All four. Okay, what are they?
If even one isn't met, boom, it typically flips over into the compensatory category. And as we'll see, that has very different accounting consequences. So, requirement one, broad participation.
Broad participation. Makes sense if it's for diversifying ownership.
Exactly. It means substantially all full-time employees meeting limited qualifications may participate. So it's not just for the execs or a select few. It's meant to be widely available.
Who usually gets excluded then?
Typically, the exclusions are narrow, maybe officers or employees who already own a significant chunk of stock. The point is, it has to be a wide offering.
Okay, widespread access. Got it. What's number two?
Number two builds on that, equal offering. Stock is offered to eligible employees equally. Now, this means everyone gets the same opportunity to participate.
Right.
But the plan can still limit the total amount of shares any single employee can purchase. Maybe they cap it to make sure more people can buy in, or just to manage the total capital being raised.
So fair chance, but not necessarily everyone gets the same amount. Okay, third.
Third, reasonable exercise period. The time permitted to exercise the rights is limited to a reasonable period.
Why is that important?
Well, it prevents these offers from just hanging out there forever. If the goal is raising capital now or diversifying ownership relatively soon, you need people to make a decision. An open-ended offer wouldn't work for, say, a time-sensitive funding need. It pushes employees to actually convert the option.
Makes sense. Keeps things moving. And the last one, number four.
The fourth one ties it all together, reasonable discount. Any discount from the market price is no greater than would be a reasonable offer of stock to shareholders or others.
Ah, so the discount can't be massive.
Right. It basically means the discount isn't some huge special perk just for employees. It should be similar to what any shareholder might get in a general stock offering, or maybe a modest employee benefit. It keeps the focus on capital raising or broad ownership, not hidden compensation.
So if a plan checks all four of those boxes, broad participation, equal offering, reasonable time, reasonable discount, it really does feel more like a financing activity.
Exactly.
So what's the big payoff for the company if a plan does qualify as non-compensatory? Why go through the trouble of meeting all these criteria?
This is the critical takeaway. If a stock option plan meets all those requirements, the company does not require the recognition of compensation expense.
Wow. No expense hits the income statement.
None. This is huge for their financials. It means they don't have to show an expense for these plans, which directly boosts reported profitability. They're treated simply as a way to get capital or spread ownership, not as a cost of doing business related to employee services.
Okay, hold on. So a company could offer potentially valuable stock rights to nearly everyone, get cash in maybe, and it doesn't hurt their reported earnings.
Correct.
That sounds like a pretty powerful tool, especially for, say, a growing company that wants to keep cash and also show strong profits to investors.
It's a significant advantage. Think about it. A high-growth tech company might report a loss, but if a big chunk of that is non-cash stock compensation from compensatory plans, an investor needs to understand that.
Right.
With non-compensatory plans, that expense isn't even there. So their reported profit looks stronger compared to a similar company using compensatory plans for the same level of, potential employee benefit.
That is a really significant difference. Okay, so if a plan doesn't meet all those criteria, even just misses one,
Then it generally falls into the other bucket.
compensatory plans. And what does that mean for companies? This sounds like where the real accounting complexity and the hit to profits comes in.
It absolutely does. When we move to compensatory stock option purchase plans, the game changes. The fundamental difference is how they're valued and accounted for. These plans are valued at the fair value of the options issued.
The fair value we talked about earlier, using those models.
Exactly. Unlike non-compensatory plans where any discount is minimal and incidental, here the entire calculated fair value of the option is considered direct compensation for the employee's services.
Okay.
And crucially, it must be recognized as an expense over time. This is a direct hit to the company's reported profits. No getting around it.
All right, so how does that work? We need the language, the key terms for these compensatory options.
Yes, let's define the key terms. First, the option price, also commonly called the exercise price.
Right, the price the employee pays.
Yes. The specific set price at which the employee can buy the underlying stock. It's the cash they have to shell out to turn the option into actual shares. Next, the exercise date. This is basically the deadline. It's the date by which the option holder must use their option. If they don't use it by then, it typically expires.
And what happens on the company's books then?
When options are actually exercised, an account on the balance sheet, often called something like stock options outstanding, gets reduced because, well, those options aren't outstanding anymore. They've become actual shares.
Got it. Then there's the big one, fair value of the option.
Yes. This is arguably the most critical number for the accounting side. As we mentioned, it's determined using an economic pricing model like Black-Scholes.
Right, the model that considers volatility, time, price, etc.
Exactly. And the key output is a concrete dollar value for those options on the day they are granted. This fair value represents the total amount the company will recognize as compensation expense over the period the employee works to earn them.
Now, I understand the model gives us an objective number, but I've heard there can still be some subjectivity, right? Especially with volatile stocks. How much wiggle room is there in practice?
That's a really perceptive question. It hits on a crucial real-world nuance. While the model, like Black-Scholes, provides the math framework, the inputs to that model often require significant judgment from management.
Ah, the inputs.
Particularly things like expected volatility, how much they think the stock price will swing in the future, and the expected term, meaning how long they estimate employees will actually hold the options before exercising them.
And that's hard to predict.
Especially for, say, a young tech company with not much trading history. Estimating future volatility can feel, more like an art than a science. Different assumptions about volatility or term can lead to pretty different fair values.
So different expense numbers.
Exactly, which means different impacts on reported profit. So while the model itself is objective, the inputs introduce subjectivity. Smart investors definitely look closely at those assumptions in the company's disclosures.
Good to know. Okay,
Well,
what other terms?
moving on, the grant date. This one's simple. It's just the date the option is officially issued to the employee.
The starting point.
Yep. The starting point for everything. Now, this next one is absolutely critical for both the company and the employee. The vesting period.
Right, we mentioned this earlier, the earning period.
Exactly. It's the period over which the employee has to perform services to actually earn the right to exercise the options. Think of it like a waiting period or an earn-out requirement. It runs from the grant date to the vesting date.
And companies use this for retention.
Definitely for retention, but also to align incentives over a longer time frame. If an employee leaves before the options vest, poof, they typically forfeit them. They never become theirs.
So it's not just about keeping people, but making sure they're committed for the long haul before they get the full benefit. Does that create a different feeling for an employee compared to, say, just getting a cash bonus?
Oh, absolutely. A cash bonus is great. It's immediate. It rewards past performance. Stock options, with that vesting schedule, inherently tie your future to the company's future. It really fosters what people call an owner's mentality.
Thinking like an owner.
Yeah, you're not just working for your salary anymore. You're working, in part, To increase the value of your own potential stake in the company. Every good decision, every successful project could ultimately increase the value of your options. That creates powerful motivation.
I can see that. That alignment is key.
It is. And closely related to the vesting period is the service period.
Okay, how is that different?
Often, it's not different in length, but it's defined from the accounting perspective. The service period is the period over which the company recognizes the compensation expense on its financial statements. It's the time during which the employee performs the service that earns them the compensation.
And usually that's the same as the vesting period.
Generally, yes. The service period is the vesting period. So if options vest over 2 years, the company recognizes the expense over those same 2 years.
Okay.
So under this fair value method for compensatory plans, the total compensation expense is measured by applying an acceptable fair value pricing model. We get that total number on the grant date.
Right, the $50,000 in our earlier thought experiment.
Exactly. But that total cost isn't expensed all at once on day one. Instead, it is allocated over the service period in accordance with the matching principle.
The matching principle, basic accounting concept, right? Match expenses to the benefits received.
Precisely. The benefit the company gets here is the employee's service. So if the employee provides service over, say, a 2-year vesting period, the compensation expense for those options is spread out recognized over those same 2 years. You match the expense recognition to the period you receive the benefit the employee's work. It reflects the economic cost of having that employee during that time.
Okay, now for the moment I've been waiting for, the aha moment, hopefully. Let's actually trace how this looks on a company's books. A real example. This is where it all comes together, right? Seeing that fair value journey.
Absolutely. Let's use example 1, accounting for stock options, ABC Co., and walk through it step by step. This will really show how these concepts hit the financial statements.
Perfect. Lay out the facts for ABC Co.
Okay. On January 1, year 1, ABC Co. grants options. These options allow employees to purchase 10,000 shares of its common stock. The stock has a par value of $5 per share.
Par value. That's usually a small, kind of arbitrary number for accounting.
Exactly. Just an accounting formality, mostly. The important price is the exercise price, which is set at $25 per share.
Okay, $25 to buy.
These options become exercisable after December 31st, year 2. That tells us the vesting period, and therefore the service period, is 2 years, year 1 and year 2.
2 years of service needed. Got it.
Now, on the grant date, Jan 1, year 1, the market price of ABC stock was $20 per share.
So the exercise price, $25, was actually higher than the market price, $20, when they were granted. They were out of the money.
Correct. They were granted out of the money. But remember, the value isn't just the immediate difference. The option pricing model looks at potential future appreciation, volatility, time.
Ah, right. The fair value calculation.
Exactly. And that model calculated the total fair value of all these options combined to be $50,000. This $50,000 is our total compensation cost that needs to be recognized.
Okay, $50,000 total cost over 2 years. Let's trace it.
Right. So January 1, year 1 grant date.
What happens?
Nothing. No journal entry required yet.
Why not? They gave out the options.
Because the employees haven't performed any services yet to earn those options. It's just a promise from ABC Co. at this point. No expense incurred, no service received yet.
Okay, makes sense. Fast forward a year, December 31, year 1, end of year 1.
Now we need to recognize the expense for the services received during year 1. Total fair value is $50,000. Service period is 2 years, so we allocate it evenly.
$50,000 divided by 2 years. $25,000 for year 1.
Precisely. $25,000 is the expense for year 1. Now, what does that look like in the accounting records?
Where does it go?
First, ABC Co. records $25,000 as compensation expense on its income statement for year 1.
Okay, so that reduces their profit for year 1.
Directly. It reflects the cost of employee services received. Second, on the balance sheet, they record a corresponding $25,000 in an equity account. You can think of this account, often called additional paid-in capital stock options, or ipixuso, as like an equity placeholder.
A placeholder?
Yeah, it represents the company's growing commitment related to these options. They've essentially paid for year 1 services with this future equity promise, not with cash today, so it builds up in equity.
Okay, expense on income statement, placeholder in equity. Got it.
Yeah.
Now, December 34, year 2. End of year 2.
Employees finish their 2nd year of service, so we do the exact same thing. Recognize the expense for year 2.
Another $25,000, $50,000 total 2 years.
Right. So another $25,000 debit to compensation expense on the income statement for year 2 reduces year 2 profit.
Okay.
And another $25,000 credit to that additional paid-in capital stock options equity account on the balance sheet.
So now that placeholder account holds the full $50,000, 25K plus 25K.
Exactly. The full $50,000 fair value has now been recognized as expense over the 2-year service period. The employees have fully earned their options. The placeholder account reflects the total value set aside in equity for these options.
Okay, service done, expense recognized. What happens when they actually use the options? Let's say January 1, year 3, all options exercised.
All right. The example says all 10,000 options are exercised. And let's say on this exercise date, the market price of the stock has gone up to $35 per share.
Nice gain for the employees. They pay $25 for stock worth $35.
Definitely a good outcome for them. But remember that $35 market price, while important for the employee, doesn't directly impact the company's accounting for the exercise itself. The accounting is based on the exercise price, $25, and the fair value already recognized, $50.
Okay, so what's the entry for the company when they exercise?
First, cash comes in. Employees pay the exercise price. So 10,000 shares times $25 exercise price equals $250,000 cash received.
Debit cash, $250,000. Good for the balance sheet.
Yep. Boosts cash. Now, remember that equity placeholder account, AP stock options, that held $50,000.
Yeah.
Since the options are being converted into actual shares, we need to clear out that placeholder. So we debit additional paid-in capital stock options for $50,000. It's moving from a temporary equity state to permanent stock.
Okay, placeholder cleared. What gets credited?
The actual common stock being issued, the par value was $5. So 10,000 shares times $5 par value equals $50,000 credit to the common stock account.
All right, so far we had $250K cash in, $50K cleared from the placeholder, and $50 recorded as common stock. The debits, $250K plus $50K to goes to $300, don't equal the credits, $50K yet. What's the rest?
Good catch. The difference represents the amount received for the stock above its par value. This goes into another equity account, usually called additional paid-in capital in excess of par, or AP common stock.
Ah, the plug figure.
Exactly. In this case, it's $250,000. $250K cash plus $50K AP so equals $300K total debits. $50K common stock plus $250K AP excess so's equals $300K total credits. It balances. This AP excess account captures both the cash received above par, $250K cash, $50K par equals $200, and the value that was already sitting in the APXO placeholder, $50K. So $200 plus $50K equals $250K.
Wow. Okay, that traces it all the way through. Very clear.
Yeah.
But what happens if employees don't exercise all their options? Maybe the stock price tanks, or they leave after vesting but before exercising. Do those compensation expenses we recorded just disappear, go away?
That's a really common question, and the answer is key. Compensation expense is not affected if options expire unexercised.
Really? Even if the company never issues the shares?
Yes. Because the expense was recognized for the service the employee provided. The company received that benefit, that service. So the cost stands on the income statement, regardless of whether the option is ultimately exercised or not.
Okay, the expense stays. So what does happen on the balance sheet with that placeholder money, the AP stock options account?
What happens is simply a reclassification of the remaining balance in that additional paid-in capital stock options account. Think of it like this. That account held value earmarked for options that might become shares. If they expire, they won't become shares.
Right.
So the value is just moved from the active options category to an expired options category within equity. It doesn't vanish. It just gets relabeled. It stays part of the company's total equity. It's basically just a balance sheet housekeeping entry.
Can we see that with the ABC example? Let's say only half the options, 5,000, were exercised and the other 5,000 expired.
Sure. So first, the exercise of 5,000 options would follow the same pattern, just halved.
Okay. Cash comes in, 5,000 shares, $25,000, so $125,000.
Right.
Debit cash, $125K.
Right. Clear out half the placeholder. Debit APIC stock options, $25,000, half of the original $50K.
Issue the stock. Credit common stock, $25,000, 5,000 shares, $5 par.
And the plug goes to APIC excess of par. Credit APIC excess, $125,000, $125K cash, plus $25K APIC so, plus $125K APIC so, $150K debits, $25K common stock, plus $125K APIC excess equals $150K credits. That part's done.
Okay, so that handles the exercise half. What about the 5,000 that expired?
The other half of the placeholder value, that remaining $25,000 in APIC stock options, needs to be reclassified. The entry is simple. Debit additional paid-in capital stock options, $25,000 to empty it out.
And credit?
Credit additional paid-in capital expired stock options, $25,000. It just moves the balance to a different equity account, reflecting that these options are no longer outstanding or exercisable. But notice, no impact on the income statement or total equity.
Got it. Expense stays, Equity just gets relabeled. Okay, that's a really thorough deep dive into traditional stock options.
Yeah.
Super helpful. But you mentioned there are other ways companies do this. There's another type, stock appreciation rights or SARs.
Yes.
How are these different from options? What makes them unique?
Stock appreciation rights, or SARs, are definitely a fascinating alternative. They have some really significant differences, especially from the employee's viewpoint and, crucially, for the company's accounting.
Okay, lay it out for us. What's the core idea?
At its core, a SAR entitles an employee to receive an amount, usually it's cash, though sometimes it can be company stock equal to the excess of the market price of stock at the exercise date over a predetermined amount.
Okay.
That predetermined amount is typically the market price of the stock back on the grant date. So basically, the company promises to pay the employee the increase in the stock's value, the appreciation, from grant date to exercise date.
Ah, so they get the value increase, not necessarily the stock itself.
Often, yes. And here's the first huge difference. Unlike stock options, stock appreciation rights do not require the employee to make a cash payment to get the benefit.
No exercise price to pay.
None. With options, you have to pony up the cash exercise price to buy the shares. With SARs, the company just pays you the difference in value, the appreciation, typically in cash.
Wow, that's a big deal for the employee. No need to find cash to exercise. Less risk for them up front.
Huge advantage. They don't have to buy the stock to profit from its rise. They just get the cash value of that rise handed to them.
So it's almost like the company says, we'll give you the profit you would have made if you'd bought the stock with an option, but you don't actually have to buy it. Why would a company choose SARs then? Especially if they have to pay out cash, what's the trade-off versus options?
That's an excellent question. It gets right to the strategy. Often it's about managing dilution versus managing cash flow and earnings volatility.
Dilution. How so?
Well, when stock options are exercised, the company usually issues new shares of stock. This increases the total number of shares out there, which dilutes the ownership percentage of existing shareholders. It can also affect earnings per share calculations.
Right, more shares dividing the same pie.
Exactly. With SARs, especially if they're settled in cash, the company doesn't issue new shares. No dilution. That can be very attractive to existing shareholders and the company itself.
Okay, avoids dilution. But you mentioned cash flow and volatility.
Right. Because the company usually expects to pay out cash, this leads to the second key distinction, which is massive for accounting. The appreciation amount multiplied by the number of rights is recorded as compensation expense and a liability.
A liability, not equity like options.
Correct. A liability on the balance sheet. This is a huge contrast to stock options, which mostly affect equity. SARs create a direct obligation, a debt the company owes, representing that future cash payout commitment.
A liability.
Okay.
And the volatility.
That comes from the third key distinction, which makes SARs accounting very lively. Compensation expense for stock appreciation rights outstanding must be adjusted annually to account for changes in the market price of the stock.
Wait, annually adjusted, unlike options where the value is fixed at grant.
Exactly. With options, you calculate the fair value on day one and then just spread that fixed cost over the service period. With SARs, the expense isn't fixed. It goes up and down with the company's stock price each year until settlement. This means the liability on the balance sheet and the compensation expense hitting the income statement each year will increase if the stock price rises and potentially decrease if it falls.
So the company's reported profit could swing wildly just because its stock price changed, even if its actual business operations were steady.
Precisely. That's the volatility headache. Imagine a CFO trying to forecast earnings when a big chunk of compensation expense depends entirely on unpredictable stock market moves.
Yikes. Okay, this sounds like something we need to see in action. How does that annual adjustment actually work? Can we run through an example?
Absolutely. It's critical for investors to understand this because it can be a blind spot if you just look at the headline numbers. Let's use example 2, stock appreciation rights, Loud Corp, to see this dynamic process unfold.
Okay, Loud Corp. What are the facts?
January 1, year 1. Loud Corp grants 10,000 SARs to Mort, its president.
10,000 SARs, got it.
They expire on January 3, year 4. When exercised, Mort gets cash for the excess of the market price over the grant date price. The service period is 2 years, year 1 and year 2.
Okay, 2-year service. And the stock prices.
Key prices. Jan 1, year 1, grant date, $30, debt on 31, year 1, $45, debt on 31, year 2, $40, debt on 31, year 2. Mort exercises all the SARs on Jan 2, year 3 when the price is still $40.
Okay, prices go up, then dip a bit. Let's see the accounting. What happens at the end of year 1, December 31, year 1?
First, calculate the appreciation per SAR. Market price is $45, grant price was $30.
$45 minus $30 is $15 appreciation.
Right. Now multiply by the number of rights. $15 appreciation times 10,000 rights equals $150,000. This is the total potential compensation value at this point.
Potential. But the service period is 2 years.
Correct. We're only 1 year in, so we recognize half the expense for year one.
Half of $150,000 is $75,000.
Exactly. So the entry for year one, debit compensation expense, $75,000, hits the income statement.
Reduces profit.
And the credit. Credit liability for SAR plan, $75,000. Goes on the balance sheet as a liability because Loud expects to pay cash later.
Okay, expense and liability booked for year 1. And December 31, year 2, this is where the adjustment happens, right?
Yes. Watch closely. First, recalculate the total required liability based on the current market price, $40, versus the grant price, $30.
Okay, $40 minus $30 is $10 appreciation per SAR now.
Right. Total required liability is now $10 appreciation times 10,000 rights, which equals $100,000.
So the liability should be $100,000 at the end of year 2. But wait, we already put $75,000 in there last year.
Exactly. We don't just expense another $100,000. We need to figure out the additional expense for year 2 to bring the liability balance up to the required $100,000.
So the total needs to be $100. We already booked $75K. The difference is $100K minus $75K. To $25,000.
Precisely. That's the expense for year 2. So the entry, debit compensation expense, $25,000.
Notice how the expense dropped from $75K in year 1 to $25K in year 2 because the stock appreciation fell?
That's the volatility in action. It directly impacts reported expense year to year. And the credit.
Credit liability for SAR plan, $25,000.
Right. And now the total balance in that liability account is $75,000 from Y1 plus $25,000 from Y2 equals $100,000, which matches the required liability based on the $40 market price. And the 2-year service period is now complete.
Okay, that makes sense. The liability always reflects the current market situation, and the expense is the adjustment needed each year. Finally, January 2, year 3, more exercises.
More exercises, all 10,000 rights. The market value is still $40. The total liability we've built up is $100,000.
So Loud Corp pays more than $100,000 cash.
Correct. The entry is straightforward. Debit liability for SAR plan, $100,000 to clear the liability off the book.
Credit cash, $100,000 as the cash goes out the door.
Exactly. Liability extinguished, cash paid. This example really shows how SARs link compensation expense directly to ongoing stock performance and require those dynamic annual accounting adjustments. It's very different from the fixed-at-grant approach for options.
Wow, that's incredibly insightful. We've gone from the basics right into the accounting weeds for both options and SARs. Okay, let's pull back up. What does all of this really mean for you, the listener? Whether you're an employee getting these things, an investor trying to value a company, or just someone curious about how business works.
Yeah, it's all about connecting these, accounting mechanics back to the real world.
Okay.
What are the ripple effects?
So for employees first.
Okay, for employees, understanding your total compensation package is way more than just looking at your base salary. These things, stock options, SARs, they can represent significant potential value, often far more than an annual bonus, especially if the company does well.
Right.
So knowing the vesting period, how long you have to stick around to earn them, and knowing the exercise mechanics for options or how the cash payout works for SARs, that's absolutely crucial.
It empowers you. Right.
Totally. It empowers you to make informed decisions about your career, about when maybe to exercise options, and how these long-term incentives fit into your personal wealth building. It really does turn you into more of a stakeholder, not just someone earning a wage. You're potentially building equity.
Okay. Makes sense for employees. What about for investors or just people watching businesses?
For investors, this knowledge is invaluable. It helps you evaluate a company's true cost structure and its financial health. When you look at those financial statements, you'll now understand that compensation expense isn't just salaries. It can include that fair value of stock options being spread out over years, or those potentially volatile liabilities from SARs. It helps you see how a company chooses to incentivize its people and what the financial impact is.
So you can ask better questions.
Exactly. Is this company managing its cash payroll by issuing a lot of equity compensation? Does it have a big SARs liability that could swing wildly with the stock price? It helps you peel back a layer of the income statement and balance sheet to see the full cost of talent and maybe the risks involved. Are they using equity smartly to align interests? Or creating future cash burdens? Vital distinction for valuing the company.
So it's not just about the bottom line profit number. It's understanding the quality of that number and how employee incentives play into it.
Precisely. And the broader implications are really profound. These mechanisms, options, and SARs, they are powerful tools specifically designed to align employee incentives with company performance.
The owner mentality again.
Yes, when the stock price goes up, everybody wins, theoretically. The company's market cap increases, it can attract more talent, and the employees' options, or SARs, become more valuable. It creates this shared interest in success. It fosters that ownership, drives performance, makes people feel like they have a real piece of the pie.
And that wraps up our deep dive into the fascinating and sometimes complex world of stock compensation. We've really unpacked how options and SARs work and how companies actually account for them right from the start through to exercise or even expiration.
It really does. And maybe this leaves you with an important question to think about.
Mm.
Given how volatile stock markets can be and these often long vesting periods, how well do these compensation tools truly align long-term employee incentives with company goals?
Mm.
Especially when, big external market forces, things totally outside the employees or even the company's control, might dictate the value of these benefits more than individual performance or the company's actual operational success.
Ah, that's a great point. How much is real alignment versus just being tied to the whims of the market?
It's a complex interplay, internal effort versus external market dynamics. Definitely something worth considering when you look at these plans.
A perfect thought to mull over as you go about your day. Thanks so much for joining us for another deep dive, and we really can't wait to explore something new with you next time.